The market is currently closed, and Plug Power Inc., trading under the ticker PLUG on the Nasdaq, closed its last session on Friday, November 7, 2025, at a price of $2.65 per share. This marked a significant increase of plus 5.58% for the day, closing toward the high end of its intraday range of $2.35 to $2.70. Now, for the deeper angle that the simple closing price doesn't tell you, that 5.58% jump happened just days before their Q3 2025 earnings report, which is expected to be announced on November 10th after the market closes. This kind of aggressive pre-earnings buying, pushing the stock well above its 50-day moving average on massive volume of over 116 million shares, suggests something beyond mere retail optimism. This isn't just a general online investing bounce in the clean energy space. It signals an acute expectation that the company is about to deliver a meaningful, positive surprise that directly addresses its perennial problem: costs and margins. The market narrative around Plug Power stock has always been one of immense potential, the future of green hydrogen infrastructure, and its long-term strategic position, but that narrative is constantly undercut by its deep unprofitability and a history of missing earnings estimates, with the company having an average negative earnings surprise of over 158% in the preceding 4 quarters. That expectation of a loss, even a narrowing one, is the common ground most investors stand on. They believe in the vision, but are deeply skeptical of the execution. Our contrarian take must look at the recent institutional activity and what may be driving this unusual pre-earnings run-up. While consensus still projects a loss of $0.13 per share, that is a projected 48% improvement from the year-ago quarter, demonstrating that the sheer scale of the green hydrogen rollout, supported by significant public policy tailwinds both domestically and in Europe, is finally starting to chip away at the operating deficit. But the real insight here is about capital and execution. Plug Power recently secured a $525 million secured credit facility, and perhaps more importantly, completed a warrant inducement transaction that raised $370 million, with the potential for an additional $1.4 billion if new warrants are fully exercised. The market's central fear has always been continuous dilutive equity offerings, the constant need to raise money by selling more shares. This debt facility and warrant management, combined with the company's Project Quantum Leap cost savings initiatives aimed at generating over $200 million in annualized savings, suggest that management is finally getting serious about shoring up the balance sheet and managing cash burn, which has been a major point of criticism for those who manage money in an individual brokerage or through platforms like Fidelity or Interactive Brokers. The spike this past Friday could very well be a delayed institutional reaction to these crucial de-risking financial maneuvers, rather than just a simplistic bet on earnings. Looking closer at the recent stock movement, the dramatic surge happened on Friday following a period of consolidation. The stock has been highly volatile, experiencing both dramatic rallies, like the period where its stock price jumped more than 150% in the last few months, and sharp pullbacks due to capital-related news. High short interest, which has hovered around 40% of the float in recent reports, adds tremendous fuel to any positive price action. A significant volume day like Friday often triggers short covering, where bearish traders are forced to buy shares to close their positions, which in turn accelerates the upward price momentum. When we talk about daily swings, the volume is key. 116 million shares is a staggering number, suggesting that large players are either initiating significant new positions or actively reducing their short bets ahead of the earnings call on Monday. This institutional conviction, whether long or short covering, is where the story is right now. Retail investors, using apps like Robinhood or automated tools like Schwab Intelligent Portfolios, need to understand that this is not a smooth growth stock, but a heavily contested battleground between long-term infrastructure bulls and short-term profitability bears. The volatility is not a bug, it is a feature of this specific stock's life cycle. The macroeconomic pressures are firmly on Plug Power's side, even if the short-term financials are messy. The global push for decarbonization is a secular tailwind measured not in quarters but in decades. Government policies, particularly the massive subsidies and tax credits in the Inflation Reduction Act, or IRA in the US, and similar programs in Europe, are designed to make green hydrogen economically viable. Plug Power's core business revolves around building an end-to-end green hydrogen ecosystem. This means they're involved in everything from manufacturing electrolyzers, the equipment that uses electricity to split water into hydrogen and oxygen, to building the plants that produce the hydrogen, to the liquefaction, storage, transportation, and finally the fuel cell systems themselves that convert the hydrogen back into electricity. Their GenDrive fuel cell systems for material handling equipment, replacing traditional lead-acid batteries and forklifts for customers like Amazon and Walmart, provided their early foundation and stable, albeit low-margin, revenue base. The high-growth, high-margin future, however, is tethered to their electrolyzer sales and the internal green hydrogen production network. The completion of their Georgia plant, the largest green hydrogen plant in the U.S., is a critical step in reducing their reliance on expensive third-party liquid hydrogen, which is a massive drag on their fuel margins. The expected reduction in production cost upon sourcing all hydrogen internally is anticipated to significantly improve their gross margins, which is the operational reality that is finally starting to catch up to the market's expectation of their future dominance. This is the financial arc that dictates whether Plug Power succeeds or becomes a footnote in the energy transition. When we consider the financial reality in more detail, we see that in the second quarter of 2025, the company reported revenue of $174 million, a 21% year-over-year increase, and showed significant year-over-year improvement in gross margin loss. This is important. An improved gross margin loss is still a loss, but it reflects operational leverage starting to kick in. The company's liquidity, while always a concern, was bolstered by the credit facility, and management has explicitly stated they anticipate no additional dilutive equity offerings this fiscal year, which directly addresses the market's expectation of constant dilution. The market has been treating this like a penny stock on steroids, but the actual operations, like the new 2-gigawatt electrolyzer supply deal with Allied Biofuels in Uzbekistan and the installation of a 5-megawatt electrolyzer in the Netherlands, are massive, multi-year infrastructure contracts that resemble a large industrial business, not a speculative biotech play. The market for hydrogen technology is still nascent, meaning that short-term revenue is volatile and dependent on the timing of massive project milestones, which can often be delayed. This is why revenue forecasts for Plug Power stock can seem stagnant while the long-term sales pipeline is growing. Investors who are engaging in self-investing or using investing sites must look past the day-to-day noise and understand that this business model is structured on large, lumpy orders and government support, not smooth, predictable consumer subscription growth like an Apple stock or a highly efficient semiconductor giant like NVIDIA stock. The future outlook for Plug Power Inc. is entirely predicated on a few key catalysts. The first and most immediate is the Q3 2025 earnings report. The key metrics to watch are not just the top and bottom line, which are expected to show a loss, but the gross margins across its business segments, equipment, service, and fuel. Any demonstrable improvement here, especially in fuel margins due to the increasing internal supply from their Georgia plant, will be viewed as a profound win that validates their integrated ecosystem strategy. A second major catalyst is continued policy support, particularly the final, clear guidance from the U.S. Treasury on the definition of clean hydrogen for the IRA's production tax credit, or 45V. Favorable guidance could dramatically reduce the final cost of green hydrogen, making it competitive with other fuels much sooner, which would be an enormous boost to Plug Power's entire business model. The third major factor is the ongoing scaling of their manufacturing capacity and supply chain efficiency. Execution risk is high, but successes like their record-setting production at the Georgia plant and the expansion of their global manufacturing footprint, including their gigafactory in New York, are crucial steps toward realizing the scale needed for profitability. The opportunity for a substantial re-rating of Plug Power stock comes from the market finally moving its focus from the current profitability deficit to the future cash flow generation capabilities of its operational assets. When enough of the hydrogen production network comes online, the company moves from being a constant cash burner to a self-sustaining